In this free video course, you will learn everything you need to know about technical analysis for trading stocks, forex, crypto, or any other financial market. By the end of this course, you will not only be able to use technical analysis to make good trading decisions and as a result make money, but you will also learn about multiple indicators and tools that most people don't know about. Let's begin here by taking a look at what you can expect to learn from this course. And the very first thing we have to take a look at is, of course, what is technical analysis? We'll take a look at the definition, but also, of course, the purpose of technical analysis. And I think it's very important to not skip over chapter 1. Because to get the most out of the following chapters, it's crucial to have a strong framework and a strong foundation of what technical analysis is. In chapter 2, it's time to take a look at candlestick charts. Candlestick charts are basically the heart of technical analysis. If you, for example, think about trends, that is just a series of higher highs and higher lows, or lower highs and lower lows that we find on the candlestick chart. And also, for example, support and resistance are just levels that we identify on the candlestick chart. Even more complicated things like trading indicators are just mathematical formulas that we apply to the candlestick chart. So your ability to understand candlestick charts can determine how good you will become at all of these other chapters. In chapter 3, it's time to take a look at trending markets. If you want to be a successful trader and make money on a consistent basis, it's very important to be able to identify if we are in an uptrend, if we are in a downtrend, or if we are in no trend at all. And as a beginner, this can often sound pretty simple. Don't you just have to look at the chart and see if the price is going up or down? Well, it's not really that simple because we need objective rules here that we can use to mechanically know if we are in an uptrend or downtrend. And I will go over these rules in a step-by-step manner so you never have to guess again. After we have a solid understanding of candlestick charts and trending markets, it's time to take a look at one of the most important concepts in technical analysis, and that is support and resistance. And we will of course take a look at what support and resistance is and why it's useful, but even more importantly, we will also take a look at how we can use support and resistance together with trending markets. And in order to understand trending markets, we need to have a solid understanding of candlestick charts. So all of the chapters in this course will build upon the previous chapters. So that is why I highly recommend to actually watch this course in order, because I have built this course in a step-by-step manner. Next up, in chapter 5, it's finally time to take a look at indicators. And indicators is a topic that many beginners are drawn towards. Beginners will often look for an indicator that does all the work for you. But what you will learn in this course is that yes, indicators can be an amazing tool. But in order to use indicators effectively, we need to understand these previous concepts as well. So the best way to use indicators is to use them in a combination with, for example, support and resistance, trending markets, and a solid understanding of candlestick charts. And in this course, I will show you guys no less than 3 of my favorite indicators. But more importantly, I will show you guys how to use the indicator together with the other technical analysis concepts. In chapter 6, we're going to talk about candlestick patterns. Candlestick patterns is one of my favorite concepts in all of technical analysis. Why? Well, because they are both simple, but at the same time, they are effective. And they are especially effective if, no surprise, we use them together with the other concepts. And last, but definitely not least, we're going to take a look at chart patterns. Chart patterns are pretty similar to candlestick patterns, but chart patterns are much larger compared to, for example, candlestick patterns. Both chart patterns and candlestick patterns can generate buy and sell signals, but candlestick patterns are more short-term, while chart patterns are broader and larger patterns. And once again, it's definitely possible to combine chart patterns and candlestick patterns. And you can also combine them with all of the previous concepts here to improve your win rate and as a result, make more money. But alright, so now we're ready to jump into chapter 1 and take a look at what is technical analysis and why is it so important. Alright then, so what is technical analysis? Well, in simple terms, technical analysis involves studying past price movements to predict future price movements. You might have heard the saying that history doesn't repeat itself, but it often rhymes. And this is basically what we technical traders do. We analyze how the chart has moved in the past to make predictions about the movement in the future. Technical traders use tools like charts, which are basically visual representations of price over time. We also use indicators that are basically mathematical calculations on historical data, and also patterns, which are specific shapes and configurations of the price data that can give us an indication of where the price is likely to go next. But what is the purpose of technical analysis? Well, we use technical analysis to make informed trading decisions. So let me be clear. Our goal with technical analysis is not to win every single trade. Our goal is basically to get a positive expected value, meaning that over a large amount of trades, we will make money. And we make these informed trading decisions by identifying buy and sell opportunities. And these buy and sell opportunities comes from the tools we use as technical traders. Last but definitely not least, another purpose of technical analysis is to manage risk. When we place a trade, we always want to have a target in mind, but more importantly, we always want to manage risk by setting a stop loss. So yeah, during the rest of the course, I want you guys to have this in mind. Now, when you know what technical analysis is and you know the purpose of technical analysis, now you're ready to learn about the tools to make informed, high probability trading decisions. And we are of course gonna start here with the heart of technical analysis. And that is candlestick charts. Alright, so what you can see on the screen right here is called a candlestick chart. And we are currently looking at Bitcoin, and we are on a daily time frame, meaning that every candlestick you can see on this chart represents one day. But let's actually go down here and switch to the Tesla stock chart. So now we're looking at Tesla, and we can switch once again. Let's go to the USD Euro chart. So right here, we're looking at the US dollar measured in euro. But what is the common theme of all of these charts? Well, one thing is that they were all daily charts, so all of the candlesticks represents one day. But the other common theme was that all of these charts were candlestick charts. And that is because candlesticks is the heart and foundation of all technical analysis. And before we can start analyze these charts and look at the big picture to find trends, buy and sell signals, apply indicators, and so on, we first need to understand how to read and interpret a single candlestick. So let's go ahead and do that now. Alright, so first of all, we have two different kinds of candles. We have a green candle, also known as a bullish candle, and we also have a red candle, also known as a bearish candle. And a green candle simply tells us that the price have been going up during the candle, and a red candle simply means that the price has been going down during the candle. And here, and this is very important, every single candlestick can represent different time frames. So for example, remember from earlier, we looked at a Bitcoin daily chart, which means that every single candlestick represents one day. But a candlestick can also represent, for example, 1 hour, or it could, for example, represent 5 minutes. Some traders specialize on trading on the daily time frame, while some traders are much better on the 5-minute time frame. To change the time frame in TradingView, by the way, if you haven't gotten started with TradingView yet, I have a special link that will be both in the top comment and the description. But to change the time frame in TradingView, you basically click on this button, and as you can see, we have tons of different time frames. Some of my favorite time frames are the 4-hour, 1 hour and 15 minutes. So let's say we want to change to the 1 hour time frame. We simply click there. And if we, let's say, want to change to the 5-minute time frame, we simply press on 5 minutes right here. So now every candlestick on the chart represent 5 minutes. But now every candlestick consists of 3 different parts. First of all, we have the body, and the body is the wide part of the candles. Next, we have something called the upper wick, and the upper wick are the small lines here, which is above the body of the candle. And last but not least, we have the lower wick, which are the lines here that are below the body of the candles. And we also have something called open, low, close, and high. And the open is basically where the price starts. So let's say that right now we're looking at 1 hour candles. And let's say that the open here is at 3 p.m. or 15. This means that the open is where the price is at 3 p.m. And the low here is the lowest point the price reached during this hour. So maybe the price moved something like this in the beginning of the hour. Then we have the high, and the high is all the way up here. The high is basically the highest point the price reached during this hour, and the close is where the price was at the end of the hour, or in other words, at 4 p.m. And the same thing is true, but the opposite for the red candle. So this candle opens right here. Let's say that this was at 12. It reached a highest point all the way up here, a lowest point all the way down here. But before the hour was over, the price bounced here. So at 1, the price was right here. So let's take a look at a real life example super quick here. Right now we're looking at Bitcoin on the 5-minute time frame, but let's change the time frame here to 1 hour. And as we can see, we are currently on a red candle. And right now it's 14:18 for me. So this candle started right here. So at 2 o'clock, the price was right here. During this hour, Bitcoin reached a highest point all the way up here. And you can see that right now, Bitcoin is trading near the lowest point during this hour. And what you also can see is that the price is of course moving all the time. You can see the price is moving up and down. And you can also see the timer right here where it says 40:16, 40:15. That means that we have 40 minutes to go before this candle closes and the next candle starts. But all right guys, so now when we have a solid understanding of how to read single candlesticks, we are now finally ready to start putting multiple candlesticks together and analyze the chart as a whole. And this is when the magic really starts to happen. But now, in order to become a successful trader, one of the most important things we need to be able to understand is if the market is trending up or if the market is trending down. Because if we can trade in the same direction as the market, we have a higher likelihood of placing successful trades. And as a result of this, we also have a higher likelihood of being profitable on a consistent basis. All right, so right now we're looking at a gold chart on the daily time frame. And when you look at this chart, would you say that the price is in an uptrend, downtrend, or that we are in no trend at all? Well, it's pretty easy to say, duh, the price is obviously going up here, so we have to be in an uptrend. And if you guessed that this was an uptrend, you were actually correct. But we are not in an uptrend simply because the price is going up. Because in order to have a real uptrend, the price needs to follow some specific rules. The first rule the price needs to follow is that in order to have an uptrend, we need to print consecutive higher highs and higher lows. So here we have a low, here we have a high, here we have a low, here we have yet another higher high, and so on and so on. So here we have a high, and here we have a low. Here we have a higher high, here we have a higher low. Higher high, higher low. And this right here is a bit hard to see, but you can see that right here we actually printed another higher high. So as long as the price is printing higher highs and higher lows, we are in an uptrend. And when we have a perfect trend that looks something like this, it's very easy to see the highs and the lows. We can clearly see that we have a high, low, we have a higher high, we have a higher low, and so on and so on. But when it comes to real markets, it's pretty much never this simple. Real markets often behaves in a much more complex manner. A real market may move something like this. We see a move up, then the price might do, something like this. We see another move up like this, and then the market might move something like this. When you look at this situation right here, it's not as easy anymore to determine what kind of trend we are in, right? So here we need some rules. We need some objective, or in other words, some mechanical step-by-step rules we can follow to determine if the trend is in an uptrend or a downtrend. And to do this, we need to learn about something called impulsive moves and pullbacks. An impulsive move is a move like right here. It's basically a move that goes in the same direction as the trend, while a move that goes in the opposite direction is called a pullback. So this right here is yet another impulsive move. This right here is a pullback. This right here is an impulsive move, and so on and so on. So to analyze this trend, it's first important to identify the impulsive moves and the pullbacks. So for example, right here, is this an impulsive move or a pullback? Well, this is an impulsive move. Then this whole move right here is our pullback. We see the next impulsive move right here, and then we see a pullback, right? A pullback. And then we have the next strong impulsive move. And the rule we need to follow here is that when an impulsive move breaks the previous high in the uptrend, so this right here is a high, and you can see that this high is broken at this point. When we break this high, this trend will still be in an uptrend as long as we are above the low of the pullback. So as you can see from this high, the price pulled back, but we did not fall below the recent low of the uptrend. So we are still in an uptrend here. And when the price eventually broke this high, right, we will still be in an uptrend as long as we maintain this low. So we are basically still in an uptrend as long as we can maintain the lows. So now let's take a look at the downtrend example. Hopefully you can see that the price right here is in a downtrend because we have an impulsive move, we have a pullback, we create a lower low, right? And then we create a lower high, and then yet another lower low. But once again, in real markets, it might look more complicated. Maybe we have something that looks more like this, perhaps something like this, right? But remember the rule here, when we break to a lower low, like we did right here, as long as the price maintains, now we're looking at the highs, as long as the price maintains this high, we are still in a downtrend. Once again, when the next low is broken right here, as long as we maintain this high, we are still in a downtrend. When the next low gets broken right here, as long as we maintain this high, we are still in a downtrend. So now I want you guys to think, where on this chart is this trend no longer in a downtrend? If you want to, feel free to pause the video and do the exercise. Well, let's analyze this chart together. So the price breaks to a new low right here, right? So as long as we maintain this high, we are in a downtrend. And when does the price breaks to yet another low? We can see that right here, the price breaks to yet another low. So in order to maintain the downtrend, we need to hold this level right here. And here you can see something very interesting. When the price pushed below this high, we saw a very strong candle. Was this a coincidence or not? Well, I can't tell you for certain, but what I can tell you is that at this point, the price broke above the high we need to hold according to my rules. And now, at least according to me, we are no longer in a downtrend. Alright, so at this point in the course, we already know quite a bit. We know how to read and understand candlesticks, and we also have objective rules to determine if we are in an uptrend or downtrend. These two skills are very important, but it is when we combine these skills together with a concept called support and resistance, we can really start finding high probability trading opportunities. So now it's time to go over one of the most powerful concepts in technical analysis, and that is support and resistance. But guys, if you have found any kind of help or value in this course so far, I would really appreciate if you can show that by dropping a like on the video. But now then, what is support and resistance? Well, support is basically a price level, or to be more precise, a price area where a stock or cryptocurrency or forex tends to find buying pressure and bounce. A support level acts as a floor and supports the price, and hence the name support level. A resistance is pretty much the opposite. Resistance is a price level or area where a stock or other asset tends to find selling pressure and as a result fall. It acts as a ceiling for the price and provides resistance and preventing the price from rising further. So let's quickly take a look at the chart right here. Here we have a clear example of support and resistance. We can see here that every time the price reached this support area, we found buying pressure and the price bounced. And conversely, when the price reached the resistance area, we found selling pressure and the price fell. And so far, this is just the basics, but we are very soon going to take a look at how we can combine support and resistance with trending markets to build a trading strategy. But before we do that, we have to learn about a very important principle. Let's take a look at this chart right here. We can see that every time the price reached this gray area, we found buying pressure, indicating that this is a support area. However, eventually, the support area broke and we saw a massive move to the downside. And before this break, we actually saw multiple signs indicating that the support level was getting weaker and weaker. And we will talk more about these signs later on in the course. But what you can see here is that after the price broke the support, the price eventually came back up to the previous support level. We saw resistance and then the price collapsed to the downside. And this right here is a very important principle. When the price falls below a support level, the same level can later flip and act as resistance in the future. This is exactly what happened in this example. And the opposite is of course also true. So if we have a resistance level and the price breaks resistance, the resistance can later on flip and act as support. And now you may of course wonder, why does this happen? Well, in this course, we're not going to dive deep into the psychology behind support and resistance, but a simple explanation here is that this can happen because traders and investors remembers the level, and they also potentially have trading orders around the level. So remember here that candlestick charts are not just random rectangles on a screen. Candlestick charts tells us a story about how buyers and sellers have been trading in the past. And as we can see on the support level, we have been seeing lots of buying pressure coming in multiple times, meaning that many people have bought around this level. So when the price broke below this level, this means that the buyers that bought here are now in a loss. So when the price eventually recovers, that means that the traders that bought on the support are no longer in a loss, and many traders will see this as an opportunity to sell at break even, and this leads to selling pressure. And another reason that can lead to even more selling pressure is that traders knows about this principle. It can act as a self-fulfilling prophecy when traders enter short positions at this level, expecting the price to reverse. And when you enter a short position, this actually leads to even more selling pressure. So now when we have a basic understanding of support and resistance, and we also know about the rules to determine what kind of trending market we are in, now we can finally put these two concepts together and build a trading strategy. So first of all, what kind of trend are we looking at right here? Well, we are looking at an uptrend, right? And why is this an uptrend? Well, we can see here that we are in a market that prints consecutive higher highs, while at the same time we are maintaining the lows. Here it can be a bit hard to see, but if you look closely, you can actually see that this low is lower compared to this low. And remember, we are still in an uptrend as long as we are maintaining the lows. So it's only if the price falls below this level right here, we are no longer in an uptrend. And one of the best ways to use support and resistance in uptrends is to look out for the resistance that the price needs to break in order to create a new high. We want to look out for this resistance to, in the future, flip and become support. So as you can see, this right here is previous resistance. When the resistance breaks, we look out for this resistance to flip and become support. This moment right here can many times act as a great buying opportunity. However, and this is very important, to make this an even better buy signal, we can combine this strategy with, for example, indicators, and we will talk about some of my favorite indicators to combine with this strategy very soon. But we can also combine this strategy with candlestick patterns, and of course we will also talk about that later on in this video. And last but not least, we can also combine this with chart patterns. And here I'm not saying that you have to use indicators, candlestick pattern and chart patterns for every single trade, but the more confluences we have at the same time, the better. And let me show you why it's important to have confirmation signals. If we take a look at this next break of the high, you can see we broke the high right here. So now we are looking out for this resistance to flip and become support. So you can see that right here we had another potential buying opportunity. But in this case, the price broke in the opposite direction, and this would have led to a losing trade. And here it's very possible that we did not have any of the confirmations we talked about recently, which made this trade more likely to fail. Let's also quickly take a look at the downtrend. We can see that we are in a downtrend right here because this trend is printing lower highs and lower lows. And what we're looking out for now is that we're looking out for support that comes from a low to flip and become resistance. And here we can look out for shorting opportunities. When you short, you bet that the market will go down, so you make money when the price falls. And this right here is one beautiful thing about trading. We as traders can profit from the market going up, but we can also make a profit from the market going down. So we as traders don't have to care if we are in a bull market or bear market. We can always find trading opportunities. Alright, so now let's take a look at this trading strategy in a real market. We are currently on the 4-hour time frame on the US dollar euro chart. And as we can see, the price pushed up right here, printed a high. So this right here is our impulsive move. Then the price pulled back. We saw another impulsive move and then another pullback. And where did this pullback go to? Well, if we use our strategy and draw out our resistance level, we can see that this high that previously acted as resistance flipped to become support here in the future. So this right here is a moment where we can look out for a buying opportunity. And as I said, later on in the course, we will take a look at exactly what to look out for. But this right here is the foundation of the strategy. Once again, we can look out for the next move. We can see that eventually we saw another impulsive move. And now remember, as long as we are holding this level, the price is still in an uptrend. Eventually, as price usually does, we saw a pullback. And if we take a look here, we can see that the price actually pulled back to the previous high, right? So here we can look out for yet another buying opportunity. Once again, the price went higher, printed a high, pulled back, printed a new high, pulled back, continued, and so on and so on. And we can actually see that even in the next pullback, the price pulled back, right, to the previous resistance that flipped to become support. However, here it's very important to just notice that this will not always work. If we, for example, take a look at the next high, you can see that the price actually pushed below, right? You can see that here the price quickly dipped below the previous resistance. But what we still have to have in mind is that even though the price dipped below that point, we are still, remember, we are still in an uptrend as long as we are maintaining this low right here. Alright, so now if you have made it this far into the course, I hope you are starting to see how it's all coming together. We learned to read candles, we learned to identify trends, and now we know about how to use support and resistance to find buying opportunities in the market. And now, in the next chapter, we're gonna take a look at how to know when to buy and when to sell. And to help us with that, we're gonna use indicators. Using indicators correctly can be pretty hard, especially when you are new to trading. And that is because many new traders dive straight into indicators before having the knowledge of, for example, trends and support and resistance. But since you have been watching the chapters from earlier in this course, you will be able to apply the indicators in a productive and correct manner. And now, before we take a look at what indicators to use and how to use them correctly, let's just quickly go over what indicators are and why they can be useful. So, first of all, what is a trading indicator? Well, in simple terms, an indicator is a tool that applies mathematical calculations to historical prices. Indicators can also use, for example, volume and other market data, but most indicators base its calculations on the price. And what is the purpose of a trading indicator? Well, first and foremost, we use trading indicators to simplify and improve our understanding of what the price is doing. And here, a very common mistake, especially for beginners, is to simply apply too many indicators to your chart. If your chart looks like this example right here, it can often make the chart harder to understand and harder to read. And that's the opposite of what we want to do. We want the indicators to help us better understand the charts, not the opposite. The second purpose here is that indicators can give us mechanical rules that can help us to know when to buy and when to sell. And that is because mathematics don't lie. So now, the first indicator I want to talk about is the RSI indicator. And to be more specific, we're gonna take a look at how we can use the RSI together with trends and the support and resistance strategy we learned earlier in this course. But first, let's take a look at some basics of the RSI indicator. The first thing we need to know is that the RSI is a momentum indicator. And momentum basically means the speed and direction of a price movement. So, right here is an example of different kinds of momentum. When we see sharp and fast movements like we see right here, we call this strong momentum. And since the price is going up, we call this strong bullish momentum. And when we see slow and flat price movements, like for example right here, we call this weak momentum. And in this particular case, we call it weak bearish momentum because the price is going down. But how does the RSI indicator work? Well, as you already know, the RSI measures momentum, but it measures momentum on a scale from 0 to 100. So right here, we have an example of the RSI indicator. And as you can see here, most of the time, the RSI will be in between 70 and 30. But the theoretical highest point it can reach is 100, although it never really reaches 100. Sometimes it can go up to like 95, but it never really touches 100. And the same thing is true for the lower range here. The RSI can theoretically reach 0 here as the lowest value, but it never really drops down to 0. It might touch 5 when the price is extremely oversold, but most of the times it will oscillate between 30 and 70. For example, right here you can see that the RSI reached just above 80 as the highest point, and we reached maybe 25 here as the lowest point. So just to repeat, most of the time the RSI moves between 30 and 70, and 0 is the highest possible bearish momentum, while 100 is the highest possible bullish momentum. Alright, so now we're back here on the same chart as before, and to open up the RSI indicator, you want to navigate up here to the Indicators tab in TradingView. I have a few indicators starred here, but let's unstar these ones. And what we simply want to search for is that we want to search for RSI. We do have multiple different variations here of the RSI indicator, but for this video, we want to open up the one called Relative Strength. So we want to click on this one right here. Next, we want to go down here to the Settings tab for the RSI. We can keep this one at 14 as it is. This basically means that the RSI uses 14 candles to make its calculations. But I want to head over here to the style tab, and I want to make sure to uncheck the RSI based moving average. That is a moving average of the RSI itself, not the actual price. And to make the RSI easier to read, I'm gonna take away the RSI background fill, and I also like to make my RSI black and also make it a bit more thicker so you clearly can see. Now we're ready to go down here and press OK. And remember, in this course, we have been focusing on trend continuation trades, meaning that we have been focusing on trading in the same direction as the price. And when it comes to trend continuation, what I'm looking out for on the RSI is something called hidden divergence. And since we are in an uptrend, what we're looking out for is hidden bullish divergence. And what is a hidden bullish divergence? Well, what we essentially want to look out for here is, first of all, we want the price to print higher lows. Remember, we're trading in the same direction as the trend, so we want the price to print higher lows. So this right here is the price. But at the same time, we want the RSI here to print lower lows. So here we have one low and then a lower low. So as you can see, in this case, the price goes in one direction, the RSI goes in the other direction. This is why we call it a divergence. And a hidden bullish divergence indicates continuation here towards the upside. So now if you want to, you can try to find a hidden bullish divergence on this chart. So feel free to pause the video right now. Did you find it? Well, let's take a look here together. If we take a look at this low right here and this low right here, we can clearly see here that the price is printing a higher low. But if we switch the attention down to the RSI, we can see that we have the corresponding low on the RSI is right here, and the corresponding low for the higher low is down here. So in this case, we can actually see that we have lower lows on the RSI. And when we have higher lows on the price, lower lows on the oscillator, this is a hidden bullish divergence and indicates continuation. And what is important here is that we don't really want to use the hidden bullish divergence on its own. But remember here, let me actually delete all the drawings. Remember here from earlier in this video, we have already identified that we flipped this previous resistance to become support. So now things are starting to come together. For example, in this point right here, we currently have sort of three bullish things happening at the same time. First of all, we have a higher low. The second bullish variable is that we are at a previous resistance that flipped to become support. And now we also have a hidden bullish divergence. So now we have three things happening at the same time, and that can many times be enough to justify a trade. Later on in this video, we will take a look at even more signals that you can use. But for now, let's say that we want to buy on this trading opportunity. So we use a long position right here. And where do we enter? We could enter right here because this is what we call a piercing pattern. It's basically when the green candle closes above the 50% mark of the red candle, and later on in this video we will talk more about candlestick patterns, but for now just notice that we did have an entry signal right there. And now the question is, where do we set our stop loss and where do we set our target? Well, one method to use is to set the stop loss here below this zone right here. So we set it below the support, and we also leave some wiggle room, so it's possible that the price can go down and test the support once again without us getting stopped out. And what about the target here? Well, as for the target, you can either use a fixed risk to reward ratio. So for example, now you can see that the risk to reward ratio says 2, and that simply means that the reward we get from winning the trade is twice as much compared to what we lose when we lose the trade. So if we use this type of 2-to-1 risk to rewards, it means that even if we only win 50% of the trades, we will still make money over time, because when we actually win, we win twice as much. But while these fixed risk to reward ratios can be a useful tool, especially for beginners, it's very simple. We can actually use an indicator to help us exactly where to place the stop loss and exactly where to set the target. So let's go ahead and take a look at the second indicator now. So the next indicator we're going to take a look at is the ATR indicator. And this indicator can be very nice because it can give us objective levels to exactly where to place the stop loss and exactly where to place the target level. But how does the ATR indicator work? Well, the ATR is an indicator that measures market volatility, or in other words, it measures how much the price moves, or to be more precise, how much the price moves on average. And to simplify the calculation here, what the ATR basically does is that it calculates the average price movement. And the most common period is to calculate the average price movement of the last 14 candles. And 14 is a very common number. Remember, for example, the RSI indicator also uses 14 periods to calculate momentum. And I usually find it valuable to, have harmony between the indicators. So if you use 14 period for the RSI, you might also want to use 14 period for the ATR and so on and so on. And if you change the settings of the RSI, you might want to consider changing the settings for the ATR indicator as well to keep the harmony here between the indicators. But now let's take a look at how do we use the ATR. Well, one use case is to use it to calculate the stop loss. And here you can use a multiplier of the ATR to manage risk. And here different traders will use different values, but a common way is to set your stop loss at 2 times the ATR. You can also use the ATR to find target levels. And once again, you can set a multiplier of the ATR to find your target levels. And this is often relative to the stop loss. So many times, what I mean by this is many times you base the stop loss based on the ATR, and then you base the target based on the actual stop loss. So both the target and the stop loss will be based on the ATR, but it's easier to base the target off the stop loss, if that makes any sense. And the benefits here of the ATR is that it can help us adjust our trading strategy according to the market conditions, or in other words, according to how much the price moves on average. So for example, right here we have an ATR indicator. It's just a simple line. And how you read this ATR is basically, if you for example take a look at right here, we can see that it says 400. This means that on this point, the price moved by 400 on average over the last 14 days. And if you, for example, read the ATR at this point right here, we can see that it says 600. So at this point, the price moved by 600 on average, and so on and so on. All right, so now let's jump back into the chart here, and let's take a look at how to open the ATR and how to use the ATR to take more informed trading decisions. To open the ATR, we want to head over here to the Indicators tab in TradingView, and no surprise, what you want to search for here is simply ATR. And with TradingView, you will always have tons of different variations of the ATR, but just the normal ATR that is called average true range is definitely good enough. So let's open that one up. Now I want to head to the settings tab here, and I just want to change, as you can see, the length here is 14, but you can change this one if you want to, but we want to keep it simple for this video, and the only thing I want to do is make the ATR a bit larger here so you guys can see it clearly. So let's press OK now. And let me also move my camera here so that you guys can see the values of the ATR. And now let's take a look here. Remember, the trade we were looking to take was right here. So what we want to do is that we want to go down to the ATR and read the ATR for that candle. And to be more precise, we want to read it from the green candle right here. We can actually use a horizontal trend line. So you can see we draw a trend line on this level, and you can see that the value here is 0.0021. I'm not going to talk about pips here because that will just confuse many beginners. You just think about this as 0.0021. And now to use the ATR, let's once again click on long position here because we're looking to buy. And remember, we want to buy on this candle right here. And here you can see that when we adjust our stop loss, you can see the value of the stop loss. So for example, if we set our stop loss right here, you can see that it says 0.0021. So right now we have a stop loss of the ATR. We have 1 times the ATR. But remember, a common value to set the stop loss is to set it at twice the ATR. So in this case, it would be right here, right? 0.0042. And if we use this kind of stop loss, we want to adjust our risk to reward ratio based on the ATR. So if we have a 2 to 1, then our target will be at 0.0084, right? 4 times 21 is 84. So this is essentially how you can use the ATR indicator to always have objective rules to set your stop loss and target. Now I want to take a moment to take a look at a very impressive indicator. This right here is the auto chart pattern indicator, and it's a relatively new indicator created by TradingView. And what this indicator basically does is that it helps us to identify chart patterns automatically. And don't worry, we will talk more about chart patterns later on in this video. But here on the chart, you can see an example of a chart pattern. This right here was a recent inverse head and shoulder pattern created on the Tesla chart. You can see we have a left shoulder, we have a head, we have a right shoulder, and when the price broke out from this pattern, look at what happened to the price. The price immediately shot up. And what you also can see here is that this indicator automatically detects target levels as well. So this right here is a very useful indicator. It's a bit different from the indicators we have been talking about earlier, but don't worry, I will show you guys how we can combine this indicator with the strategy we have been talking about. And as I mentioned, one feature of this indicator is that it finds target levels automatically, and that is very, very nice. The only downside with this indicator is that it has a requirement. In order to use this indicator, you need TradingView Premium. However, I have a special link that will be both in the top comment of this video as well as the description. And you can use that link to try out TradingView Premium for free for 30 days. And if you fall in love with this indicator and TradingView Premium, by using the link, you will get a $15 bonus if you decide that you want to continue using TradingView Premium. And also guys, if you use the link, you at the same time support the channel. So thank you all so much in advance. Alright, so to demonstrate how to use the auto chart pattern indicator, I actually do want to change the chart here. I want to go to Tesla and I want to change the time frame here to a daily time frame. I also want to hide the RSI indicator and hide the ATR for now. And now to open up the indicator, we want to head up to the indicators tab in TradingView. And what you want to search for here is all chart patterns. And the indicator you want to choose is this one right here called all chart patterns. Next, we want to head up here to the settings tab for the indicator. And here you can see that we have tons of different chart patterns, for example, double top, double bottom. And here you can basically choose all the patterns you want this indicator to display automatically on the chart. And here on the in progress tab, you can also choose to display patterns that are currently in the process of being formed. So for now, just to demonstrate, let's choose all the patterns here. And here on visibility, we can also choose to display all the patterns. You can see currently we are just looking at the most recent pattern, but if we press all here, the indicator will show all of the patterns. And you can also here choose to display the price targets or not. But for now, let's show all the patterns and all the price targets. And now we are ready to go down here and press OK. So as you can see, it looks a bit messy here on the chart, but now we can see all the patterns that this indicator found. So for example, right here, you can see that the indicator identified a rising wedge. A rising wedge is when the price prints higher highs and higher lows, but the range here is getting tighter and tighter. And you can see right here, the price broke out from the pattern. And when the price breaks the pattern, you will get an automatic price target. So this right here is a bearish pattern where you bet against the direction of the market, and this pattern was reached at this point right here. Another pattern you can see is the head and shoulders pattern. And this is this pattern that goes like this. This was the pattern I talked about earlier. You can see we have one low right here, which is called the left shoulder. We have a lower low that is called the head. And then we have a higher low that is called the right shoulder. And the reason this is called a head and shoulder is because it's basically, it basically looks like a head and shoulder. In this case, it's an inverse head and shoulders. It basically looks like someone's head and shoulder, but upside down. But as you can see, in this case, the pattern broke right here. We found an automatic target all the way up here. And you can see in this case, this price target got reached very quickly. We also have a falling wedge right here, which is a continuation pattern. So we had a move towards the upside. The price consolidated here. We broke out and the target was right here. So as you guys can see, this right here is an amazing tool. But just as with the other indicators, it's important here that these patterns they can be useful on their own, but they are best used when you combine the patterns with other technical indicators. So for example, in this video, we have been focusing on trading an uptrend. And remember, our goal here was to buy the pullbacks and preferably buy at support. And the interesting thing here is that many patterns are continuation patterns, meaning that the goal of the patterns is to continue the trend towards the upside. And we will talk about some continuation patterns later on. But if we find, let's say that we find a falling wedge during this pullback, and a falling wedge is the opposite of the rising wedge here. So it's basically when we print lower highs and lower lows, but the range here is getting tighter. If we find a falling wedge and it breaks out here near the support level, that is yet another confirmation that can increase the likelihood of a successful trade. So you can definitely combine chart patterns with trend trading to improve your probabilities of succeeding and as a result increase your profit. But as I said guys, if you want to try out this indicator, make sure to use the link in the description or in the comment and you will get a $15 bonus towards your new plan. So now guys, the time has come to take a look at candlestick patterns. Candlestick patterns is one of my favorite concepts in technical analysis because they are pretty simple to learn, and if used correctly, they can be a very powerful tool and give an indication of where the price is likely to go next. So, what are candlestick patterns? Well, candlestick patterns are visual representations of price movements during a specific time frame that gives hints about where the price will go next. Or to be more specific, where the price is likely to go next. No candlestick pattern can predict price movements with 100% certainty, and as with all technical tools, they are best used when you combine them with other technical variables. And when it comes to candlestick patterns, they are often relatively small. We are talking about maybe 1 to 5 candles. If you, for example, compare candlestick patterns to chart patterns can often be much larger, as you saw earlier in the course. And we also have different types of candlestick patterns. We have bullish patterns, which signals potential price increases, and we also have bearish patterns that signals potential price decreases. We also have reversal patterns, and reversal patterns indicates a potential change in trend direction. So remember the inverse head and shoulders we talked about, that is an example of a chart pattern, a reversal chart pattern, because before the pattern appears we have a downtrend, and the goal of this pattern is to reverse the price to the upside. But when it comes to candlestick patterns, these are often much smaller reversals. So if you, for example, have an uptrend, we can find a reversal pattern that simply reverse the pullback. So these are often much smaller reversal patterns compared to chart patterns. And we also have something called continuation patterns. A continuation pattern should suggest that the move will continue. So once again, for example, if we have a trend, you might find a continuation candlestick pattern within the actual impulsive moves that sort of suggests that the impulse will continue. Now let's take a look at some of my favorite candlestick patterns that you definitely need to know about. The first candlestick pattern you need to learn is called the bullish engulfing pattern. And this pattern is a complex pattern. Why do we call this a complex pattern? Well, I call all the patterns that consist of 2 or more candles complex patterns. The direction here is bullish and the type is reversal. So before the pattern we have a downtrend, and these 2 candles are the actual bullish engulfing pattern, and the goal of this pattern is to reverse the price to the upside. So to identify the pattern, you first need to identify a move towards the downside. And remember here that this move can be a pullback, so it can simply be a pullback in an uptrend. And the goal of this pattern is to reverse the price. The first candle of the pattern is a red one. And the next candle is a large green candle that opens below the real body of the red candle and closes above the real body of the red candle. So it needs to open below the close of the red candle and close above the open of the red candle. It's also fine if you have the red candle like this and that the green candle opens at the same level of the red candle but closes above. This right here can also count as a bullish engulfing pattern, because in some markets the next candle will always open where the previous candle closes. So both of these variations are fine. All right, so let's jump back here to the chart. You are probably, very familiar by now. This is the 4-hour time frame, US dollar measured in euro. And here I actually want to show you guys a bullish engulfing pattern. If you look closely, you can see that right here we actually saw a bullish engulfing, right? If we zoom in on this candle, you can clearly see that this green candle opens below the body of the previous red candle and closes far above the body of the previous red candle. When this candle closes, so when this 4-hour candle is done, the bullish engulfing pattern is confirmed, and this is a potential buy signal. But remember here, in order to find a good buy signal, what we want to look out for in our trend continuation strategy is that we want this bullish engulfing to come at a support level. And here you can see we have a support, and this support comes from the swing high right here. The price went down, we broke above this level, and then with this bullish engulfing pattern, we tested this previous resistance as support. So this right here is a valid buy signal, so we take our long position. And where do we enter? Well, the most common way to enter the bullish engulfing is to enter here at the candle close of the green candle. That is when the pattern is confirmed. And as for your stop loss level, you know by now that we have a few different methods to set stop loss. A simple method is to set the stop loss below the support, so you can set it right around here. The second method is, remember to use the ATR indicator, which we have down here. But to keep it simple for this example, we can use a fixed risk to reward. So we set the stop loss just below the support level, and using a risk to reward ratio of 2, your trade would have looked something like this. You can see this was a very nice example. Just a few candles later, we locked in some nice profit. The next candlestick pattern you definitely need to learn is the hammer pattern. The hammer pattern is what I call a simple pattern because it consists of only one candlestick. The direction here is bullish, and the type here is once again a reversal. So before the pattern, we need to see a move towards the downside. Once again, this can either be a pullback or it can be a larger impulsive move. Then this right here is the actual pattern, and the goal of the pattern is to reverse the price to the upside. To identify the pattern, what you're looking out for is that you're looking out for a candle with a small real body and a long lower wick. And we want this wick to be at least twice the size compared to the length of the real body. And preferably we want the wick to be maybe 3 times or even 4 times as large as the real body. Also, when it comes to the upper wick right here, we want this wick to be either small or non-existent at all. As a rule of thumb, we want this wick to at least be smaller than the body of the candle. But now let's jump back here. We're looking at the exact same chart as before. I think it's a good way to, just show the same chart all the time. So we can see that these kind of signals happens all the time. And the question here, can we find a hammer on this chart? Well, I can't really find a good hammer here. One could argue, if you look at this candle, you can see this candle right here. Let me actually zoom in here even more so you can clearly see. You can see for this candle, we indeed have a small real body, right? And we have a pretty long lower wick. We can see that this wick is probably more than twice as large as the real body. So if you only look at the actual pattern, this is actually a hammer. But remember here, in order to have a valid hammer, we want to move before the hammer to be a downwards move. And in this case, we can actually see that the candles here before the hammer was pretty much just going sideways. By the way, these two candles right here have a special name. They are called doji candles, and they basically represent market indecision. But for now, we can notice that we did not really see a downwards move from this candle. And the other problem with this candle is that it did not appear at a support level. You can see our support is all the way down here. So this candle pretty much appears in the middle of nowhere. So in this particular case, this was not really a good signal. And this is something very important about trading. You will find sort of small signals all the time, but we as traders only want to focus and we only want to take trades on the best signals. Alright, so next I want to take a look at the bullish momentum pattern. This right here is a super useful pattern because it happens all the time in the market. This right here is a simple pattern because it consists of only one candlestick. The direction here is bullish and the type here is continuation, meaning that the goal of this pattern is to continue the preceding uptrend to an uptrend even after the pattern. However, it's a bit too simplistic to say that a bullish momentum pattern is only a continuation pattern, because a bullish momentum pattern can also act as a reversal as well. For example, many engulfing patterns will actually be both a bullish engulfing and a bullish momentum at the same time, and you will soon know why. Because what is a bullish momentum pattern? Well, I like to define this as a candle, a strong green candle that is at least twice the size of the previous candles. And preferably we want the momentum candle to be even larger, maybe 3 times or 4 times as large as the previous candles. And as a rule of thumb, what I usually do is that I measure around 3 candles before the momentum candle appears. And if the actual momentum candle is at least twice the size, I will consider this a bullish momentum. And let's jump back here to the same chart as before. Let me delete this one. Let's see if we can find any, let's see if we can find any bullish momentum candles. Well, if we take a close look right here, we can see a strong green candle. We can also see that before this candle appears, we have a slight upwards movement. And what we also notice, if we take a look at the previous 3 candles, we can see that the body of this candle is more than twice the size compared to the bodies of the previous candles. So we can consider this a bullish momentum. Another good thing about this momentum candle is that we actually see the candle coming in here near a support level. This was not a perfect support because the price actually dipped below just slightly. We saw like a few fake outs of this level. But remember from earlier in the course, we are still in an uptrend because we are still printing higher highs and higher lows. As long as we don't break below this area right here, we are still within an uptrend. So now last but definitely not least, let's take a look at chart patterns. Chart patterns are much larger than candlestick patterns, and they can be a bit harder to master. But at the same time, when you learn to use chart patterns correctly, and also when you learn to combine chart patterns with other technical variables, the outcome can be really rewarding. But first of all, what are chart patterns? Well, once again, chart patterns are visual formations on price charts that help to predict future price movements. So for example, right here, we have a chart pattern. This right here is known as a bull flag, and it's one of the best chart patterns out there. We will talk about how to trade the bull flag very soon. And one of the key differences between chart patterns and candlestick patterns, as I already mentioned, is the size. Chart patterns are large. They usually consist of 10 to maybe 50 or even more candles. And what are the components of a chart pattern? Well, chart patterns uses support and resistance, and by now we are very familiar with support and resistance. Chart patterns also use trend lines. And what is a trend line? Well, a trend line is basically a sloping resistance or a sloping support. So the principles we talked about earlier in the course can basically be applied for trend lines as well. And what is the usage here of chart patterns? Well, we use chart patterns to identify entry and exit points in the market, and we also use them for risk management. The first chart pattern I want to show you guys is called the ascending triangle. And in my personal opinion, this is one of the best chart patterns because it provides very clear buy signals, and we also have very clear levels for where to place our stop loss and where to place our targets. This pattern right here is a bullish continuation pattern. So before the pattern appears, we want to see a move towards the upside. Then this sort of red part is the actual pattern, and the goal here is to continue the price movement towards the upside. To identify an ascending triangle, we first need to identify a resistance level. Here you can see that we have a clear resistance. The price got rejected multiple times at a level indicating selling pressure. The next thing we need to identify is that we want to see higher lows. So here we have a low, here we have a higher low, yet another higher low, and yet another higher low. So what we then do is that we draw a support line like this. And now this is a bit ugly, but you can hopefully clearly see that a triangle is created between the resistance and the support. Alright, so here is a real life example of the ascending triangle. As you can see, we have a move towards the upside. The price clearly finds a resistance. You can see we get rejected 1 time, 2 time, 3 time, 4 time, we get rejected here. And at the same time, we're printing a low, a higher low, higher low, and higher low. And now you might of course wonder, how do we actually trade this pattern? Well, the most common way to enter this pattern is to enter on the breakout, or in other words, to enter on the candle close of the actual candle that breaks the pattern. The stop loss for this pattern is usually set below the most recent low before the breakout. And as for your target level, what we usually do is that we measure the length from the stop loss to the target, and we use a fixed risk to reward ratio, such as a 2-to-1. But what you also can use is that you can of course use the ATR indicator to adjust your stop loss based on the market volatility. Now, the next pattern I want to show you guys is the bullish flag. Personally, I really like this pattern, and this pattern is also perfect for this video because this right here is a bullish continuation pattern, and what we have been focusing on in this video is trading in the same direction as the trend, and this is exactly what the bull flag pattern does. What we need to identify to find a bull flag is that we first need to identify an impulsive move like this, and then we want to see a pullback. This is very simple. A pullback, which is a move against the direction of the trend. And in this pullback, what we're usually looking out for is a few lower highs and a few lower lows. And remember from earlier in the course, this is still an uptrend until the price breaks below this point. So this right here is basically like a small downtrend within the uptrend. If you zoom into shorter term timeframes, you will be able to actually find larger trends within the longer term timeframes. So let's actually see if we can find a bull flag on this trend we have been talking about. To make it a bit more clear here, let me actually delete some of these black lines. I don't think we need them anymore. You know about the structure of trends. But for example, this was not perfect, but this can almost be considered a bull flag. So we draw a sloping line like this, we draw a sloping line like this, and what you can see here is that the price moves down, tests the support, moves up, moves down once again, and then we finally broke above the bull flag. However, this right here was far from a perfect bull flag, and I think it's important that I show you guys examples that are, not perfect patterns, because when you are trading in real markets, you will realize that so many times the patterns will be far from perfect, and you may wonder what is making this not a perfect bull flag. Well, when it comes to bull flags, what we're looking out for is that when we break the downward sloping resistance, we preferably want to see a strong candle. And as you can see, when we broke this resistance right here, we didn't really see any kind of strong momentum. So this right here was a bull flag I would have avoided. So for example, in this case, the test of the support we talked about earlier, so this test right here was, at least in my opinion, a much better buy signal compared to the signal from the bull flag. To show you guys a better example of a bull flag, we have one right here. You can see we had an impulsive move, the price went down, tested support, up again as resistance, down again as support, and then we broke the pattern right here. And what made this a good breakout was that this breakout candle was a pretty strong breakout, making the pattern more likely to actually succeed. So the common way to enter is to enter at the candle close of the breakout candle. The stop loss is usually placed below the low of the bull flag. And as for your target, you can use a fixed risk to reward ratio, or you can use the ATR indicator. You can also definitely combine the bull flag with other technical variables such as the RSI indicator. And remember, if you want to use an indicator that identifies bull flags automatically, you have the auto chart pattern indicator. So now last but definitely not least, we of course have to take a look at the double bottom pattern. This right here is an amazing pattern, especially for beginners, because it's very simple to spot, and if you master the double bottom, it can definitely be a useful pattern. So this right here is a bullish reversal pattern. So before this pattern appears, we want to see a move towards the downside. Then what we're looking out for is that we're looking out for one and then two lows here at the around same level. These two lows doesn't have to be on the exact same level, but they should be around the same level. And what we then usually do is that we draw a horizontal line here that connect the high between these two lows. And what we're looking out for is that we're looking out for the break of this level, or some traders actually specialize at trying to buy on the second low. So here is a real life example of the double bottom. You can see that we have a move towards the downside. Then we see one low and two lows appearing here at the around same level. And then at this point right here, the price broke above the resistance that comes from the highs here in between the two lows. And the most common way to enter is to enter at the breakout. So the entry is usually placed at the candle close of the breakout. The stop loss is usually placed below the double bottom, so below the lowest low. And as for your target, you can use a fixed risk to reward, you can use the ATR indicator, or you can use other market structure. But as I said, some traders also specialize in trying to buy the low here. This can be a bit harder. And if you do this, what I definitely recommend is that you have multiple other bullish confirmations, increasing the likelihood of this being a successful trade. And if you look closely at this candle right here, we can actually see that this counts as a bullish engulfing. This is a case when the green candle, or in this case the white candle, opens at the same level as the red candle, but you can see that the close of this candle is clearly above the real body of the red one. So here we can see this as a bullish engulfing. So some traders might have tried to enter right here already at this candle close. The good thing about this entry method is that you enter at a cheaper price. You also have a pretty clear stop loss. And to, for example, reach a 2-to-1 risk to reward, the price doesn't have to rise as high compared to the other entry method. As I said, this entry method is a bit harder and maybe not suitable for beginners. Alright guys, so this course is coming to an end very, very soon. But real quick, before we wrap up, I want to thank you all so much for watching. And also, if you guys found any kind of help or value from this course, please consider dropping a like on the video. Every single like helps the channel and our community grow, so I'm super thankful if you take some time to smash that thumbs up. And also, of course, if you have any kind of questions or feedback about this course, don't hesitate to leave a comment down below. I'm trying my very best to read every single comment. And last, but definitely not least, when you are ready to learn more about trading and technical analysis, I highly recommend to check out this playlist right here. In this playlist, you will find all the educational trading videos I have made so far, and more is coming very, very soon. But yeah, guys, I hope you all will have an amazing day, and I hope I will see you guys in another video very, very soon. Take care. Ciao, ciao.